Good morning. November 2nd, 2022 school land board meeting was scheduled to begin at 10 a.m. this morning. We're having some technical difficulties. We'll adjourn and reconvene the meeting at 12 o'clock today. Thank you. All right. Good morning or afternoon, as the case may be. The November 2nd, 2022 school land board meeting will reconvene. We convened at 10 a.m. this morning. Originally had some problems with the audio visual end, so we adjourned and are now reconvening at noon. So pursuant to section 31.015 of the Texas Natural Resources Code, I'm chairing this meeting in the commissioner's absence as chief clerk of the general land office, as the commissioner is away on state business. November 2, 2022 meeting of the school land board is being held in person at 1700 North Congress Avenue, Stephen F. Austin Building, and by video conference call as authorized under Texas Government Code section 551.125. Access to the meeting by members of the public was published in advance in the Texas Register in accordance with the Texas Opens Meetings Act. Any member of the public who wishes to address the school land board should indicate so at the start of the meeting or during any public comment period. And I do want to note that before we get to the agenda items, item number 3C, 7, and 8 were pulled from the docket prior to this meeting. That being said, first item on the agenda is item number 1, approval of the minutes from the September 6, 2022 school land board meeting. So you've had a moment to review. I will take a motion.
Motion to approve.
Second.
Motion is made, seconded, and carries unanimously to approve the minutes. Next item on the agenda is item number 2 with our oil and gas lease sale.
Good morning, board members. Robert Hatter with the Energy Resources Division. Staff has opened the bids and reviewed them. The Permanent School Fund received $15,379,283.92 total. And that was from 28 oil and gas bids and 1 geothermal bid. The oil and gas bids averaged about $6,000 per acre across the board. Notable oil and gas tracts were one in Reagan County. These are all in West Texas. Reagan County for a little over 16,000 an acre. Loving County right at 20,000 per acre, and Reeves County at $27,800 an acre. The geothermal tract went for $8.46 per acre. So the bonus per acre you see on the totals there is when you put the two together. So I wanted to separate those out for you. So we did get an average of about 6,000 per acre. Staff has reviewed the bids and recommends the board approve all high bids that meet the minimum at this time, unless you have any questions.
Are there any questions from the board?
I move to approve.
Second.
Motion is made, seconded, carries unanimously to approve the bids from the second 2022 oil and gas lease sale. And now for the record, we're going to have the winning bids read into the record.
Thank you.
Deborah Cantu, Energy Resources. I will begin reading all bids received. Marginal number 1, Dome Energy, $49,895. Marginal number 1, Dome Energy, $41,911.80. Marginal number 2, $2,244,444. Marginal number 4, DE Permian LLC, $1,878,679. Marginal number 4, Moon Tower Resources LLC, $1,119,099. Marginal number 5, Texas Independent Exploration Limited, $336,000. Marginal number 6, Texas Independent Exploration Limited, $420,000. Marginal number 10, Petro Hunt LLC, $1,014,400. Marginal number 11, Petro Hunt LLC, $1,014,400. Marginal number 17, Apache Corporation, $660,256.56. Marginal number 17, Dion Alanese, $600,133.86. Marginal number 18, Anna Darko, E&P Onshore LLC, $1,560,000. Marginal number 19, Anna Darko, E&P Onshore LLC, $1,704,000. Marginal number 22, Wesley Cooper, $126,430.85. Marginal number 23, Ageron Energy LLC, $31,982.11. Marginal number 24, Ammonite Oil and Gas, Inc., $25,036. Marginal number 25, Ammonite Oil and Gas, Inc., $2,748. Marginal number 28, Ammonite Oil and Gas, Inc., $125,180. Marginal number 28, Brent Broussard, $125,000. Marginal number 30, Ammonite Oil and Gas, Inc., $25,036. Marginal number 31, Ammonite Oil and Gas, Inc., $121,992. Marginal number 33, Ammonite Oil and Gas, Inc., $208,920. Marginal number 34, Ammonite Oil and Gas, Inc., $56,304. Marginal number 37, Southern Star Exploration LLC, $30,000. Marginal number 41, Lamar Oil and Gas, Inc., $40,000. Marginal number 60, Saxit Energy Incorporated, $69,000. Marginal number 64, Scheffler Energy Group Incorporated, $218,290. Marginal number 66, TR Offshore LLC, $73,440. Marginal number 67, TR Offshore LLC, $73,440. Marginal number 71, Earthbridge Energy LLC, $5,414.40. Marginal number 71, Earthbridge Energy LLC, $5,408. Marginal number 74, Permian Delaware Enterprises Holdings LLC, $3,200,000. Marginal number 75, Emerald Gathering and Transmission LLC, $32,000. Marginal number 76, Emerald Gathering and Transmission LLC, $32,000. That concludes the reading of the bids.
Thank you very much. Next item on the agenda is item number 3, approval of the consent agenda. And as a reminder, item number 3C, 7, and 8 was pulled prior to the meeting. Any questions? If not, we'll take a motion to approve item number 3.
I move to approve.
I'll second.
There's a motion, second, and carried unanimously to approve the consent agenda. Next item on the agenda is item number 4.
Good afternoon, board members. I'm Ken Mills with the Oil and Gas section in the Office of General Counsel. Item 4 is the application of Continental Resources, Inc. to lease 5,843.88 mineral acres for oil and gas development. It's located under land that Continental owns in Reeves and Pecos counties. This is the Trees Ranch, and it's something that Continental acquired from Pioneer. Because Continental is both the surface owner and the proposed lessee, Section 52.190 of the Natural Resources Code says that the board can consider this application, but Continental is required to waive its agency rights in this lease. So with that waiver, the commissioner will sign the lease, and there will not be a sharing of bonus and royalties with the surface owner as ordinarily would be with RAL acreage. The proposed lease is for a 3-year primary term. It's a $350 an acre bonus, which you might notice is somewhat less than was average in the bid sale just now. This acreage has been drilled pretty much to density in the Wolfcamp, and what Continental is proposing to do is to drill deeper depths, which are more unproven acreage. So that's a $350 an acre bonus with a 20% royalty, which again, the permanent school fund gets all of rather than splitting with the surface owner. Staff recommends acceptance of the agency waiver and recommends approval of the lease terms as I've just described them, and I'd be happy to answer any questions.
Ken, how many acres did you say it was?
It is 5,843.88 acres. I'm not sure it's exactly 9 sections, but that's roughly the number of REL tracts is 9 full 640 acre sections. And this is a large ranch called the Trees Ranch in that part of the state that straddles the Reeves-Pecos County line.
And under the original lease, was it restricted to the Wolf Camp?
No, this has been leased for a while and has been developed for a while. It's just Wolf Camp has been the that's been the golden boy reservoir for the last 10 years, and it has the Continental's predecessors, Parsley and Pioneer, have drilled this area extensively. In fact, almost to full density. And as I say, their proposal now is to come back and release the acreage to pick up deeper depths that had fallen out of the leases previously. So they're going to be going lower than Wolf Camp.
I'm just trying to figure out if it wasn't restricted to the Wolf Camp, so they had to all depths, why they had that?
Our leases have retained acreage provisions so that depths that are not drilled at a certain point in time that's spelled out in the lease are terminated.
Okay.
And so, and in fact, deeper depths, as we generally refer to it, that's sort of been the major leasing issue for the last 5 or 6 years, because so many leases that were signed between 5 and 10 years ago have had their assessment date come and go, where lease acreage, either surface acreage that was never drilled and accounted for at the Railroad Commission, and or depths that were never reached, come back to us to be leased again.
And do you know what the formation is? Did they identify the formation?
I'm not sure exactly which one they're aiming at. Robert might know, Canyon, or
Right.
Probably not too much deeper than Wolf Camp, just because it starts getting really expensive to drill.
Robert Hatter with Energy Resources. Yeah, right beneath the Wolf Camp is the Cisco and the Canyon. Below that is going to be Strawn and Atoka. There is historic production from the Strawn and Atoka in that Reeves County area, but it's quite a bit deeper than the Wolf Camp. And as Ken said, our retained acreage clauses started to kick in several years ago, and we started receiving the deeper rights back.
So this is a different play than the shale in Reeves County then?
Yes, it'll be below the Wolf Camp.
The Wolf Camp.
And if you go far enough south in that county, there's even production from the Woodford, which is even substantially deeper.
Okay, thank you.
You're welcome.
In fact, we saw some of the deeper rights leased in this current lease sale, correct?
Yes, sir.
Okay.
Hmm.
Any other questions from the board?
Well, that's an exceptionally big ranch. Wow. Motion to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 4. Next item on the agenda is number 5.
Good afternoon, Nick Orman with the Office of General Counsel. Item number 5 is a request by Diamond Edge Energy to extend the primary term of an oil and gas lease they hold covering 575 acres in the San Jacinto River in Scott Bay in Harris County. Under the Natural Resources Code, the board may agree to suspend the lease and effectively extend the primary term if a lessee is unable to obtain in a timely manner a permit from a governmental entity. Some of you know, in state waters, you need a permit from the Corps of Engineers, which is also dependent upon comment and approval from THC, Texas Parks and Wildlife, Port of Houston, and the City of Baytown, as well as other ancillary permits. At the May 2021 meeting, the board agreed to grant Diamond Edge an extension of 1 year. So their current primary term ends on January of 2023. Diamond Edge has provided us a detailed list of the steps they've taken in that time to work towards getting approval from the Corps. However, they've been informed that the process will not conclude any sooner than April of 2023. Therefore, they've requested a second extension to push the primary term to January 17 of 2024. Excuse me. Their report, it's pretty evident they're spending money and taking steps to work towards getting that approval. They've just been grinding through the process and responding to supplemental information and things that the Corps requested of them. So staff recommends approval of the suspension, and I'm happy to answer any questions.
So it sounds like the applicant has been pursuing this in good faith, doing everything that's asked of them, just kind of getting caught in the Corps' timeline.
Yes, sir. And as I said, the report has dates so that you can see there's been no gap. It's not like anybody's been asleep at the wheel. They've really been actively working, and it's just kind of going back and forth, doing extra above and beyond sort of biohazard survey to locate buried pipeline, just kind of various things that come up. So yes, they agree they have been working in good faith.
Okay. Any questions from the board? Hearing
No.
none.
No question.
Questions, there a motion?
Motion approved.
Second.
Motion is made, seconded, and carries unanimously to approve item number 5.
Thank you.
Thank you. Items number 6 and 7 will be in executive session. School Land Board will enter executive session pursuant to Chapter 551, Subchapter D, Texas Government Code, Section 551.071. Consultation with its attorneys regarding matters involving attorney-client privileged information and legal issues associated with items number 6 and 7. Following executive session, the board will reconvene in open session to complete the docket. Thank you. The open session of the November 2nd, 2022 School Land Board meeting will resume with item number 6.
Good morning, Amber Long, Asset Management. Staff recommends approval of this item per the terms discussed in closed session. Any questions?
Any questions from the board on item number 6?
I move to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 6. Next item on the agenda is number 7.
And Mr. Chairman, before Mr. Martin begins, I did want to note for the record that Commissioner Bush did file a recusal memo on this particular item. He is away, as you said, on state business, but I do want to note that's in the official records of the SLB for this meeting.
Duly noted. Thank you.
Thank you, Mr. Chairman. Members, for the record, Rusty Martin, Chief Investment Officer. Approval of this agenda item will constitute your approval of an investment by the General Land Office on behalf of the Permanent School Fund in the 2022 Wellington Fund LP. The Investment Advisory Committee is recommending that GLO invest $100 million on behalf of the PSF in Wellington. Wellington is a proposed $108 million separate account arrangement between the GLO and the McKinney Fund and Company. It's created to invest in multifamily workforce housing development located primarily in the southwestern U.S. The GLO has a longstanding relationship with the McKinney team that began in 2008 and has resulted in total original capital commitments of $175 million across 3 separate account arrangements. Investment management staff and the Townsend Group conducted due diligence and analysis on the Wellington proposal through a series of meetings and discussions with the McKinney team over the past few months. In addition, the McKinney team made a detailed presentation to the IAC in Townsend on October 13th. Following that presentation, the IAC voted unanimously to recommend the proposed investment to the School Land Board. All members of the IAC were present and voted. In conjunction with this discussion, review, and analysis, Investment Management worked with Townsend and legal counsel to ensure that the proposed investment fits within the framework of the TexGlow PSF investment policy statement and is in the best interest of the permanent school fund. Therefore, the IC is recommending a capital commitment to the 2022 Wellington Fund LP of $100 million. And as usual, your approval of this transaction is contingent upon Investment Management's completion of the negotiation, finalization of the legal documentation associated with the proposed investment. I'm happy to answer any questions.
Any questions from the board on item number 7?
Yes, Rusty, thank you for the great presentation and for bringing good investments to the board. I just want to make sure that when the documents are being prepared to sign, that staff looks at the McKinney Fund and talks through any deals that may already be in the queue and make sure that they've been marked to market over the last 3 to 6 weeks, since there's been such a dramatic change. And I think that it would be good to know what the parameters of the equity percentage, the debt percentage, and the interest rates during construction and the potential exit caps are now as compared to what they were 6 months ago, so that we don't make some investments, or the McKinney Fund doesn't make investments that are based on old numbers, because the markets have changed so dramatically. So that would be my request.
Point taken, and we'll take that into consideration when we're negotiating the documentation. Thank you, Mr. Rohrman.
Any additional questions?
Gil, you got anything?
No, no questions.
All right.
Well covered by you.
Well, I move to approve.
Second,
Motion is made, seconded, and carries unanimously to approve item number 7. Next item on the agenda is a non-action item, the quarterly investment report.
Thank you, Mr. Chairman, members. As you mentioned, this is a non-voting item. It's a quarterly investment report for the GLO Permanent School Fund Investment Portfolio for the period April 1st through June 30th of this year. The performance measurement calculations and the statistical data that are presented in the report were prepared by State Street Bank and its Private Edge Group, which are the custodial, accounting, and performance measurement agents for the portfolio. Briefly, looking at the overall economy, second quarter GDP decreased at an annual rate of about 0.6%, and that followed a decrease of about 1.6% for the first quarter. The unemployment rate ended the quarter at 3.6%. That was unchanged from 3.6% at the end of the first quarter. As far as the Fed is concerned, in June, they decided to raise their target Fed funds rate by 75 basis points from a range of 0.75 to 1% up to 1.5 to 1.75%. That rate increase followed actions that they took in March of this year as well as May of this year. And they also stated at that June meeting that they anticipate ongoing increases in the target range will be appropriate, and also that they would continue to reduce their holdings of Treasury securities, agency debt, and agency mortgage-backed securities. They also stated that they're strongly committed to returning inflation to its 2% objective, and they're going to continue monitoring the implications of a wide range of incoming information for the economic outlook, and that they would be prepared to adjust the stance of monetary policy as appropriate if risk emerge that could impede the attainment of their goals. In the real estate markets, looking at the commercial real estate market is measured by the NCREIF Property Index, or NPI. That market returned 3.23% for the quarter ended in June. The average quarterly return over the life of NPI is 2.25%. The trailing one-year return on the index was 21.46%. The gross total returns for each of the individual sectors in NPI were hotel up 1.8%, retail up 1.68%, apartment up 3.8%, 3.86%, office up about 0.5%, and industrial was up 5.86% for the quarter. Again, industrial was the best performing sector, and that's continued due to continued strong performance in the industrial warehouse space. And that sector has led all property types since first quarter of 2016. Market value cap rates ended the quarter at 3.83%. However, over the history of the NPI, those cap rates have averaged 6.59%, so they're well below average historical averages. In the energy markets, WTI spot crude oil prices averaged about $108.83 a barrel during the quarter, ending the quarter at 107.76 a barrel, and that was a 7% increase in first quarter prices and 147% year over year increase. Oil demand now is back to near pre-COVID levels, with COVID lockdowns ending in China. However, near-term U.S. and global recession fears are starting to push oil prices back down to the mid-$90 a barrel range. That was subsequent to quarter end. They peaked on June the 8th of this year at $121.94 a barrel. Inventory levels are still tight despite concerns of a potential recession, and several bullish and near-term drivers remain in place. Number one, China's strong return to the market and its unwillingness to go into lockdown again. Increasing risk of Russian oil and gas supply cuts to Europe this winter as tensions continue to rise over the Ukraine issue, and continued strong demand readings outside the U.S. Looking ahead to 2023, most analysts believe that the global oil supply will grow slightly, but fundamentally the market will remain well positioned for healthy oil prices. As far as natural gas is concerned, Henry Hub natural gas spot prices averaged $7.50 per million BTUs during the quarter, ended the quarter at $6.54 per million BTU. That was a 20% increase from first quarter prices and a 73% year over year increase. Factors contributing to that rally are geopolitical tensions caused by the Russia-Ukraine conflict, global demand and U.S. exports ramping up considerably, and U.S. production growth has proven slower than most industry experts predicted due to operator capital discipline and significant infrastructure constraints. Pricing fundamentals remain strong as we push into the peak demand winter months, and additional pricing increases could occur if the Russia-Ukraine conflict escalates or if Europe experiences a very cold winter. Medium to long-term fundamentals for natural gas remain strong as gas continues to take center stage as the foundational transition fuel as the world continues on its transition to cleaner fuel sources. Turning to the actual performance of the portfolio and looking at page 2 of your report, you see that the total net asset value at the end of the quarter, June 30, was $6.957 billion. The portfolio accounted for 90% of that, and cash equivalents was about 10%. Looking at the performance focused on gross returns without cash for the quarter, again, this is a very strong quarter. Portfolio was up 6.79% versus the quarter versus 4.24% on the benchmark, so an outperformance of 255 basis points. All of the sectors of the portfolio performed extremely well. Real estate was up 5.36% for the quarter. Infrastructure was up 7.63%, and energy was up 7.32%. Looking at the longer term returns, again, they are outstanding returns, particularly in the 1-year returns. 1-year return at June 30 on a gross basis was 43.6% versus 1852 on the benchmark. So an outperformance of 2,508 basis points.
Wow.
The individual 1-year sector returns of the portfolio were amazingly strong. Energy was up 64.82%. Real estate was up 36.43%. and infrastructure 23.79%. So just exceedingly strong numbers. Even the longer term measurements are all very strong. The 3-year return is 13.26 versus 10.18 on the benchmark. 5-year returns 14.07 versus 8.62 on the benchmark. It's an outperformance of 545 basis points. And even the 10-year average annual return over the last 10 years is 14.19% versus 8.70 on the benchmark. So almost 550 basis points of outperformance there. Also, if you look at the return target as stated in the investment policy statement, that policy return target is based on the 5-year rolling average net of fees return. And on that basis, the portfolio performed at 11.35%. That's 5-year average annual net return, 11.35% versus 6.15 on the benchmark. So 520 basis points of outperformance there. Strong, very, very strong performance. At the end of the quarter, about 22% of our existing capital commitments remained unfunded, 18% of real estate, 27% of infrastructure, and 20% of energy. Looking at new investments during the quarter, if you look at page 3 of the report, you can see that the board approved 2 new fund investments and 1 new co-investment during the quarter. The co-investment is a vehicle created to co-invest alongside First Reserve in a U.S.-focused upstream strategy. The NCAP Energy Transition Fund 2 is a fund that's focused on the decarbonization of the U.S. power sector and other opportunities created by the continuing global transition to a lower carbon energy system. And NCAP Midstream 5 is a fund focused on the North American midstream energy opportunity set, consisting primarily of greenfield and brownfield hydrocarbon and energy evolution opportunities. Subsequent to the second quarter, and as shown on page 15 under subsequent events, the board approved 3 new fund investments during the third quarter. One of those was Macquarie Infrastructure Partners 6. That is a fund investing in infrastructure and infrastructure-related assets and businesses located predominantly in the U.S. and Canada. The next one was Macquarie GIG Energy Transition Solutions. That's a fund that's going to invest globally in sustainable infrastructure and real assets, along with infrastructure enabling technology and services platforms that are capable of driving sustainable energy solutions designed to facilitate the worldwide decarbonization process and help accelerate the current global green energy transition. Finally, Westbrook 12 is a real estate fund focused on pursuing opportunistic investments across the primary real estate sectors on a global basis, arising primarily from undervalued assets, corporate and government divestitures and realizations. Looking at the allocations by asset type on pages 7 and 8, you can see that the allocation of real estate was 31%. This is based on NAV versus a target of 33%. Infrastructure was at 25% versus a target of 36%. And energy was at 44% versus a target of 31%. Those targets reflect the new targets adopted by the board in April of 2021, and they're designed to reduce exposure to extreme levels of volatility in the energy sector going forward. Over time, those actual allocations will become more aligned with the policy allocation targets as the board makes new capital commitments in the various sectors and as more of the existing unfunded capital commitments become funded. On page 8, you can see that the allocations on an invested basis plus unfunded commitments was 29% to real estate versus a target of 33%, 29% to infrastructure versus a target of 36%, and 42% to energy versus a target of 31%. And just to note that the infrastructure is relatively far under its target for a couple of reasons. Number one, A lot of those those infrastructure investments are in the life cycle where they're starting to harvest those investments. So we've gotten a lot of capital back. And as you know, during this year, we've made a lot more commitments to infrastructure too. So as those become funded, that allocation will creep up more closely to the target. And then energy is way over allocated, but that's just because there's been such a huge run up in oil and gas commodity prices, and that's reflected in those valuations. So that will also mediate over time. As far as geographic diversification is concerned, on pages 11 to 12, the allocation to the U.S. is about 95% of the portfolio. The target is 90%. So the international allocation is 5% compared to a target of 10%. And again, those targets will they reflect targets adopted by the board in April, and they will change as more unfunded commitments are funded. As far as investment manager exposure is concerned, on page 13 to 14 of the report, we're well diversified across a platform of 25 different investment managers. Our policy statement limits the exposure to any one investment manager to no more than 20% of the total portfolio. At the end of the quarter, we're well within that range. The top 5 highest exposures are InCap Energy at 13.4%, USAA Equity Advisors at 12.02%, Macquarie Infrastructure Partners at 9.57%, Clarion at 8.22%, and Limerock Resources at 7.66%. Co-investment vehicles are grouped by manager and presented separately. The highest grouped co-investment exposures at the end of June were First Reserve at 6.27%, Limerock Resources at 3.40%, ArcLight at 3.10%, and BlackRock at 2.87%. That concludes my presentation. This is a non-voting item, but I'm happy to answer any questions you may have.
Well, those numbers, as you reported them, are awesome. Thank you.
Thank you.
43% 1-year return. Not bad. Not bad.
I've always said, I wish I could invest with I could have a sidecar. I would love to have a sidecar.
We're very happy with the performance. It represents a lot of work, certainly on the part of my team, on the consultants that we work with, on the board itself, and everybody that's involved in the process. So we're happy and we're gratified, and look forward to continuing to do that. Although I don't think I'm going to be reporting 1-year returns at 43.6% too frequently in the future.
All right. Well, that being a non-action item and no further business before the school land board, the meeting is hereby adjourned.